What's going on, you guys? It's Shiraz Ahmed coming at you with some more financial and business content. In today's video, I wanted to go over my top tips if you're a newbie investor just getting into the world of investing in the stock market. So this is a video you're going to want to check out, so stay tuned. Okay, for those of you who aren't familiar with me or who I am or what I do, my name is Shiraz Ahmed. I am a financial advisor and associate portfolio manager with Sartorial Wealth of Raymond James, located in Toronto, Canada. I am a cross-border licensed advisor, which means I work with families in both Canada and the United States. And so for today's video, I wanted to go over my top tips for newer investors into the stock market on what to do. And I know that it can seem really kind of overwhelming and daunting if you're just getting into the world. So part of what I'm looking to do with this channel overall is to really just give you guys, frankly, the basics of what this world of investing is really all about. So before I get too deep into it, if you could please smash that like, subscribe, and bell icon. It really does help the algorithm pick up creators like me. So without further ado, let's jump in. Okay, so point number one, and this is arguably one of the most important of all the points I'm about to make, which is time in the market versus trying to time the market. And the reason why this is so important actually comes from a study that was conducted in 1986 by a group of financial professionals and CFAs, collectively known as GHB. I believe that is, or BHB, sorry, that's Brinson, Hood, and B. Bauer. And what they came up was a study on portfolio determinants, or what actually determines the performance of your portfolio. And funny enough, market timing only accounted for about 2% of your overall return. Security selection, deciding whether or not, you bought Apple versus Google, or, Microsoft versus Amazon, or whatever. That, funny enough, only had about a 5% impact on your overall portfolio. But greater than 90% of your overall return, funny enough, came from asset allocation. So that's like deciding bigger picture concepts like, am I going to be in the United States versus Canada? Or am I going to be in North America versus international, or stocks or bonds, or a combination, or commodities? Those bigger picture conversations had a much larger impact on the overall portfolio return, which is why that was such an important concept that they wanted to hit home. So that mixed in with other concepts like, what happens when you miss the 10 best days in the market, etc. It has a really big impact, and no one knows what's going to happen in the future. So in general, try to focus more on what you can control versus what you can't. So you can control your behavior, you can't control the outcome of the market, because no one knows what's going to happen tomorrow. So that's going to be my biggest piece of advice for point number one, is focus more about time in the market than trying to time the market. Point number two, and this one's also kind of related to the first one, is really ultimately decide, are you a trader or an investor? And I say this because there's actually a fundamental difference between the two. Is a trader takes a very short, sometimes ultra short-term horizon to when they're making their investments, usually done because they want to earn a specific amount of money over a specific period of time, whether that be I want to earn $100 a day or $200 a day in order to meet your whatever objectives that you may or may not be. That's more of a trader mentality. They're not getting into the nitty-gritty of the actual companies. You're not looking at any of the major sort of investor-related metrics that we would normally look at. You're more looking at the movement of the price of the security. So it's a fundamental difference between whether you're trading versus investing. Investing, it takes a much larger time horizon, and other variables and factors come into play when you're investing versus trading. So you have to kind of decide, a bit of a line in the sand, are you a trader or are you an investor? And both are good, they're just different. I'd also just kind of caution anybody who's trying to get into the world of higher frequency trading. It is not for the faint of heart, so be careful. It can be dangerous if you're not really watching very closely. Number three, and this is kind of an interesting one, is I get people asking me all the time professionally is, okay, well, I want to do this. I have X amount of money. I want to start investing, but I don't know where to start. Well, an easy way to start is kind of more of a couch potato kind of methodology, is start by looking around what is in your house, right? Start paying attention to the labels of the products that you're bringing into your home, because there's a good chance that millions of other people kind of do the same thing and they're buying the same products. Usually they're made by pretty good companies for the most part, because if you're consuming them, chances are many other people are doing the same. Now, I'm not getting into the quantification of are they good companies, are they a good fit for your portfolio? That's a whole separate topic. But just in general, as a starting point to kind of filter down the universe of the thousands upon thousands of securities that exist, there's no way for you or anybody to keep track of them all. It's frankly impossible. So you got to filter into something that's more bite-sized that you can actually digest yourself. So an easy way to do that is look at the products that you consume in your house. When you start flipping them over or looking at the labels, you'll realize that a lot of these are kind of big box, multinational, really blue chippy type companies like the Colgate-Palmolives of the world and the GlaxoSmithKlines and all these other major corporations that kind of make almost everything. So that's a good starting point for if you're not sure. Otherwise, feel free to reach out to me offline and we can get a little bit more salient if you want. And point number 4, this is probably, again, one of the more important ones, is don't try to be a hero. I can't tell you how often investors come to me with these kind of outrageous ideas of what their rate or sustainable rate of return will be. Some people come in thinking that you're always going to get double-digit returns. And guess what? Over the course of your life, that's not a sustainable situation unless you have a really ridiculously high risk tolerance. So for your average person and most people out there, you're going to get kind of a modest rate of return relative to what you're comfortable doing. So kind of keeping into check. You don't have to try to swing for a home run or a grand slam every time. I mean, you strike out like crazy when you do that. And unlike sports, in the real world of money, if you strike out, you might not ever get to play again. So be cautious about not just deciding if you're going to invest, but more importantly, how much are you going to invest? It's kind of like sort of going into the world of poker, right? It's how much do you bet on that hand? Well, you don't bet the farm on everything unless you're really, really confident. But this is where you want to be really careful, is you don't need to be a hero. So I always say this, you'll hear me say this again and again, time is your best friend when it comes to investing. The longer that you have, the less, funny enough, rate of return you really need to get you to where you want to be, because time does the heavy lifting for you. So hopefully this gives you guys a couple kind of points to take home if you're just starting to get into the world of investing and building your portfolio. It's not something that you need to be overly concerned about, kind of slow and steady, ease your one toe into the water at a time, and really just kind of be cautious about what you're doing and learn. And really, people mystify this space so much. But if you're feeling like this is kind of over your head and it's not something that you feel comfortable doing, that's where professionals do come in, people like myself and others out there. So if you ever feel like you're kind of out of your depth and this is more than you're capable of handling, that's when I maybe suggest seeking out professional guidance, and that might be worth your time. So though, if there's any other topics that you guys want me to cover, please feel free, drop me a line. I'll put my contact information at the end. And otherwise, happy hunting and best wishes for everybody for 2021. Hopefully it's better than 2020. All the best, guys. Bye for now.